Despite everything going wrong in the stock market this year, a lot of dividend investors like myself have actually been seeing some really encouraging things. Because stock prices have been falling so much, it's resulted in dividend yields increasing, thus allowing our investing dollars to go further in terms of collecting dividends. It's also resulted in us being able to reinvest and pick up more shares of our favorite dividend stocks at a discount. And on top of that, many holdings out there have actually increased their dividend payouts despite share prices falling so much this year in nearly every sector of the market. In today's video, I'm actually going to go over a few of my holdings that just recently raised their dividends within the last few weeks. All of these stocks currently offer yields of over 10%, and they're all currently paying record dividends. So with that being said, let's go ahead and get started. The first stock we're looking at is Alrock Capital Corporation, ticker ORCC. This is a business development company that makes investments in senior secured or unsecured loans, subordinated loans, and also considers equity-related securities including warrants and preferred stock. Alrock seeks to invest in growth, acquisitions, expansions, and refinancing. They invest in U.S. companies with an EBITDA between $10 million and $250 million annually and/or annual revenue of $50 million and $2.5 billion. It's owned and managed by Blue Owl, which is a large specialty finance company that has over $94 billion worth of assets under management. Their stock currently trades for $13.08 per share, and it offers a dividend yield of 10.09%. Earlier this month, the company announced that they were increasing their quarterly dividend distribution for the first time in their history to now 33 cents per share. On top of that, the company also announced that they'd be paying a special dividend this month too of 3 cents per share. You can see their dividend distribution graph that Alrock has always paid 30 cents per share per quarter since their IPO back in 2019. They did pay special dividends in the past, but not since 2020. For some reason, this graph is only showing their most recent special dividend. They have paid more special dividends in the past, ranging from 4 cents to 8 cents per share, but for some reason, it's not showing correctly. I remember shortly after coming across this company a couple years ago, I knew it had a lot of potential. Despite launching their stock only 3 years ago, Alrock is already one of the largest business development companies in the sector. As of third quarter of this year, they had a total portfolio size of $12.8 billion, which is significantly larger than most BDCs, but still a ways away from being larger than Ares Capital, who now have a total portfolio value of $21.3 billion. Last time I checked, I think they're currently the third largest BDC. But their investments are spread out across 180 companies, and 87% of their loans are senior secured, which has been pretty consistent since their IPO. 98% of their loans are floating rate loans. I've talked about this several times before, but what this means is, as interest rates rise, Alrock can earn more money from their investments. When interest rates go up, the company earns more revenue from their investments, thus explaining the increased dividends and that supplemental dividend this month. Their biggest investments are in the internet and software services sector, financial services, and insurance. The companies they typically invest in are in the upper middle market, which bring in between $500 million and $1 billion in revenue. So overall, Alrock has been a company that's kept delivering some really good results this year, and honestly since being founded. To date, they continue to be one of my favorite business development companies out there. The next stock we're going to look at that just recently grew its dividend to an all-time high is TriplePoint Venture Growth, ticker TPVG. This is another business development company that specializes in making investments in venture capital-backed companies during their growth stage. Having been founded back in 2013, this company provides debt financing to venture growth space companies, which includes growth capital loans, secured and customized loans, equipment financing, and direct equity investments. They're externally managed by their sponsor, which is TriplePoint Capital, who've been in business since 2006, and they're headquartered in Menlo Park, California. After more than 8 years of no dividend growth, TriplePoint recently announced an increase, going from 36 cents per share to now 37 cents per share. So not exactly a significant increase, but a dividend hike is always appreciated. The company has also paid special dividends in the past, just like Alrock, but they haven't announced a special dividend since December of 2020. You can see over the last 5 years, their distributions have been pretty steady, with an occasional special dividend every now and then. But now they've grown their dividends starting next quarter, and hopefully they'll be able to maintain this level going forward. But currently their stock trades for $13.08 per share, and it currently offers a dividend yield of 11.31% according to Google. As I've talked about in the past, TriplePoint Venture Growth is not like most BDCs that we've seen, in that they are a little different in a couple ways. They exclusively like to focus on technology, life sciences, and other high-growth industries, which is similar to a couple of other BDCs like Hercules Capital, for example, but TriplePoint only lends to companies that are venture capital-backed and during their venture growth stage. It's a very specific period during a company's startup process when a company has already proven themselves to have achieved a sizable amount of success and they're seeking additional funding to further expand their business. Basically, in order to provide financing for a company, TriplePoint needs to see a sizable amount of track record in a company first. Other business development companies will lend money at other stages during a company's growth, or they'll provide financing to help rescue a company out of a dire situation through restructuring. But TriplePoint doesn't assist with those kinds of businesses. So in a way, this does provide more protection, since in order for TriplePoint to consider offering a business financing, they would have had to have provided a lot of proof that they're already pretty successful. So in summary, TriplePoint's had a lot of success providing financing to businesses like Facebook, Square, Beyond Meat, Etsy, and a whole lot of other really recognizable companies. They're another BDC that I've been a fan of, although I consider them to be riskier than Alrock currently. Finally, the last stock we're going to look at that's been paying me record dividends is Oaktree Specialty Lending Corporation, ticker OCSL. They're a specialty finance company dedicated to providing customized one-stop credit solutions to companies with limited access to public or syndicated capital markets. Oaktree seeks to generate current income and capital appreciation by providing companies with flexible and innovative financing solutions, including first and second lien loans, unsecured and mezzanine loans, and preferred equity. They invest in companies with an enterprise value between $20 million and $150 million and an EBITDA between $3 million and $50 million. Oaktree Specialty Lending is another BDC that was launched just before the worst of the financial crisis back in 2008. Their stock currently trades for $7.14 per share, and according to Google, they currently offer a dividend yield of 10.08%. On November 15th, the company announced that they were increasing their quarterly dividend again to now 18 cents per share. OCSL has really been a pretty good company in terms of dividend growth over the last few years. Since September of 2020, their stock has increased their dividend every single quarter. It should also be noted that they did also announce a special dividend of 14 cents per share, which is payable at the same time as their regular quarterly dividend. It's their first special dividend distribution in more than 4 years, according to their website. The story of Oaktree Specialty Lending is a little interesting because the company it is today is pretty different compared to when they were first founded. You can see when their company had their IPO back in 2008, it started at around $11 per share, and for a few years it had a flatlining share price. But starting in late 2012, the company started going on a downward trend, both in share price and dividend distributions. It continued all the way until about 2019 when Brookfield, which is a large Canadian asset manager, stepped in and actually acquired 61.2% of this company. Once Brookfield took over in September of that year, you can see the share price rose by over 40% up until 2022 when the whole market started to fall. But as of June of this year, Oaktree currently has over $2.6 billion worth of investments in 151 companies. 87% of their investments are in senior secured loans compared to unsecured and equity investments. Application software is their largest holding, followed by pharmaceuticals and data processing and outsourced services. Just like a lot of other BDCs, Oaktree holds an overwhelming majority of floating rate loans, which make up about 88% of their portfolio. It's actually a bit lower than other BDCs, but still at over 88%, it's been a big help for them in terms of increasing their dividends. Thanks to rising interest rates, this company now earns 9.3% on their debt compared to 8.8% back in March of this year. So in the end, these are 3 companies I invest in that have kept posting some really excellent results, and I've been pretty happy with their performance. If you've been a shareholder of any of these stocks, then I'm sure you've been pretty happy with the increased dividend distributions recently as well. Feel free to share your opinions down in the comments section about these stocks. Do you hold any of them, or are there better stocks out there that have given you even better returns? If you are interested in any of these holdings, then be sure to perform your own research and come to your own conclusion on whether or not these stocks are a good fit for your own portfolio.